So when we're calculating EVA, and if operating profit is given, besides those usual adjustments such as P&L item conversion, P&L conversion to cash, well, for example, when we remove a fact over provisions, etc., and capitalization over research and development, marketing, and training, excluding one-off items. Well, and let us write it separately, and charge over economic amortization / depreciation in start of accounting. What else do we need to do? Well, if it's operating profit after tax, we need to deduct tax actually paid. And we will find it not in a P&L that is given, but in notes. So you will be told that you will see in P&L that tax expense is, let's say, 100, but tax actually paid was 105, then you will take 105. However, we will also need to deduct extra tax. We will deduct tax relief on finance cost, which is going to be calculated as finance cost multiplied by tax rate. Okay, let us talk about how to find tax paid if it's not given to you. We will make a rule. So we will see tax at the beginning of the year. We will add tax charged in P&L. We will take tax at the end of the year. And tax paid will be the balancing figure. So tax paid, balancing figure. This will go to EVA TM calculation. Tax at the beginning of the year and at the end of the year will be taken from statement of financial position or balance sheet. Okay. Now, this is what we do when we have operating profit. If we have profit after tax, the story will be a little bit different. Well, ordinary adjustments would be the same, but we need to see the difference. What is the difference between profit after tax and operating profit? Profit after tax is operating profit plus finance income minus finance cost minus tax, but not just like the tax that we need, but operating tax. Okay, so what do we need to do? So to get to operating profit, what we are going to do, we will need to add back finance expense. Finance expense, it can be called finance cost charged. Then we will need to deduct finance income. And then we will need to correct the tax. Well, see, profit after tax is an accounting figure. So it takes tax that is charged to P&L. And therefore, we need to add back tax expense in P&L. And then what is going to be, we will deduct tax actually paid so it will not be in P&L, it will be in notes. And then we will deduct tax relief on finance cost. And tax relief on finance cost is going to be finance cost multiplied by tax rate. See, finance cost and finance expense is the same. So sometimes you will get it's called as finance cost. Sometimes you will get called as finance expense. Totally the same thing. So the same. All right. So let us summarize that. Let us summarize what we have learned about finance cost. Why? Because you will need to explain the adjustment that you made, because this is how your question is formulated quite often. So you will say, as finance cost is factored in weighted average cost of capital calculation, it should not be included in no-part calculation and should be, and if it's a profit after tax, you would say that if part is given, is used, it should be added back to profit after tax. So the first part, you will write if operating profit is used. So you will say why you didn't take into account finance cost. And the one in brackets is what you are going to write if you are given profit after tax. All right, and now about tax relief on finance cost. Tax relief on finance cost charged in P&L. Will correct tax calculation. Will adjust tax calculation for notional operating profit after tax, as it is already included in weighted average cost of capital calculation. Now let's talk about tax. As for tax, we say that we need to take not tax charged in profit and loss, but paid. Why? As EVA trademark looks into cash, then XXX company should adjust notional operation profit after tax, not for profit, not for tax paid, just tax charged, but for tax paid. Okay, now what does it mean? It means that we will always need to reduce operating profit by loss tax relief on finance cost. So operating profit will be reduced by lost tax relief on finance cost in the amount of, and we take finance cost from PL multiplied by tax rate. Well, theoretically, if it was financial income, then you would use financial income, but I've never seen questions like that. But just know that it's going to be. It can be. Okay. And now going to numerical examples. I've listed a few for you. During the year, 100,000 over advertising cost, which will generate sales in future periods, was expensed to the income statement. This advertising attracted 100 customers in the reporting year and will attract 400 customers in the following year. So what does it mean? Well, this is what exactly we mean when we say that advertising is going to create long-term value, because it only attracted 100 customers in this year, but the major benefit will be in the following year, so it will be later. Okay, so as advertising cost will generate economic benefits for several periods, the $100,000 spent should be capitalized. Then they will be amortized based on the useful life. Well, and useful life is usually in years, but here it's in number of customers, so we will use that. As in the reporting year, only 100 customers out of 100 plus 400 equals 500 customers were attracted. Then only 100,000 divided by 500 of total customers in multiplied by 100 equals to 20,000 should be deducted from operating profit as amortization. Yes, this is what we correct in our notional operating profit after tax. And then what we need to do, we need to also correct capital employed, but we will need to correct capital employed for the next year. And in the questions that are given to us in the exam, we do not need to talk about next year unless we're asked, but for you to understand the concept, because it has to be a double entry, so it has to have debits and credits, I will write to you what is going to happen. So, what does it mean? It means that it will increase capital employed for that next year in the amount of, and I take the capitalized originally 100,000 and subtract from it the amortization that was already charged, and that gives me $80,000. Okay, so but the important thing is that in this very example, we were told that that happened during the year. So somewhere in the year we do not know, and when something during the year happens, we know that we do not know when, and we assume it's in the end of December. But if you are told that that expense happened at the start of the year and the beginning of the year, then you would say, if you were told that's true, well, let me just rewrite that at the start of the year. Oh. At the start of, sorry, on the start of the year, 100,000 of advertising cost, which will generate sales in future periods, was expensed to the income statement. Then you would do the following. You would say, as advertising cost brought economic benefits in, well, let's say in current year, then the 100,000 should be capitalized and included in the capital employed calculation for current year EVA in capital employed for current EVA TM calculation. So the difference is that if something happened during the year, then we do not include that in capital employed for the start of the year. We include that in the capital employed that we are going to use in next year EVA calculation. But if some expense that is going to be capitalized happened at the start of the year, we say that we're going to use the result of the expense in the current year, so we do capitalize that as capital employed. And as for the depreciation amortization, well, it happens as it was before. As for amortization, it will happen based on the scenario. Well, for example, if the 100 customers came this year and 100 are expected to come next year, then we would write totally the same. So the difference is what we do with the capital employed. Okay, going next. Let's have a look at the allowances, provisions, and hello. Okay, let me try to copy it once again. The allowance for doubtful debts at the end of the period was 300,000, a reduction of 200,000 from the beginning of the period. That is tricky English. So a reduction of 200,000 from the beginning of the period means that at the beginning of the period, allowance was 500,000. So 300 plus 200. So we say, as bad debt allowance is a non-cash item, it should be corrected for no part calculation. As it was reduced, means that current year operating profit contains income from bad debt allowance reduction, and that income should be reversed. So reversed means that we need to decrease operating profit, should be decreased in no part calculation. In the amount of 200,000. And very important, consequently, capital employed at the start of the year will be reduced by the value of bad debt allowance at the start of the year, which means so look, in our accounting, increased. What does it mean? It means that in our accounting brackets, we had bad debt allowance, and that decreased our assets. But we say, no, we do not need that. So we take it away, and our assets need to be increased, which means increased by 200,000 plus 300,000 equals 500,000. So that would impact two parts of the calculation. Okay. Now, depreciation charges. Let us see. Example. Depreciation charges of 100 million in the year have been incurred. Okay, so what do? We say that we need to take accounting depreciation back, we need to add it back, and then we need to charge economic depreciation. And well, quite often you will be given economic depreciation, and you would, for example, add back 2,000 but deduct economic depreciation of 1,000. But if you're not given, you need to show the examiner that you know that this is one of the major adjustments. So you say, as economic depreciation is not given, it is assumed that it equals to accounting depreciation, and therefore no adjustment is required. Okay, so when no part is calculated, the company, and we need to write the name of the company, so ACCA company, should add back accounting depreciation and charge economic depreciation instead to show the real usage of non-current assets. However, as no economic depreciation is given, it is assumed that it equals accounting depreciation, and thus no adjustment is required. All right. Going next. The company has spent $90 million this year and each year for the previous 10 years on long-term brand building. So what does it mean? Well, investment in brand is long-term value creation. So we need to capitalize the expenses, which means that we need to take that 90 and multiply that by 10, and $900 million are going to be the correction of capital employed. We take for 10 years, not for 11. We do not take current year in capital employed adjustment, because capital employed adjustment is calculated at the start of the year. And then 90 is going to be added back in current year no part calculation. So as a cost of brand building relates to long-term value creation, the 90 million should be added back to notional operating profit calculation. Also, capital employed at the start of the year and the start of the year should be increased by previous spend over 90 million multiplied by 10 of 900. So only for previous, as company uses the results of the expenses. So then it would be wise to charge the depreciation. So we would depreciate or amortize that 900. But if you are not given any years, any indication of how long the brand is going to be, then you need to actually start that. Well, usually after capitalization, this long-term value creation amortized, but it seems that XXX company is unaware of how long it is going to be used. As such, Access company needs to double check that capitalized brand will indeed bring as much value. So, because maybe some costs do need to be expensed in current periods. Okay, so that is it. And let us have a look at capital employed. So for capital employed, we will always take capital employed at the start of the year. And capital employed at the start of the year can be broken down in parts. So you will have capital employed as per accounting, and then some corrections. So when you have some corrections, some adjustments, make sure that you will not record an adjustment that is already there. Well, for example, for a previous example, that 900 is not included and that list of adjustments. Okay, so that's it. That's some examples of how economic value is going to be adjusted, and what is important, not only to know how to calculate, but also to explain, because the majority of marks will be for explanation.